Hello, everybody, and very welcome to this episode 4 of Get Real with Mute Digital. Today, we have a very special topic and something that's been sounding for the last week. It's been a very hot topic, and that's tokenized equities. Seems that everybody's trying to convert equity into a token. And we see even big players doing this and central exchanges doing it. So we're going to discuss, we're going to give our point of views, we're going to hear our founders. They're always here sharing their expertise and their points of views and what they think is going to happen and follow up on things happening. So let's get started on it. Uh, would you like to say welcome, Patrick Cholo? You know the drill about how we're gonna do these episodes.
Yeah, for sure. No, I think for everyone, GMU, we made it to episode 4. Haven't been canceled yet, still on air. So thank you for everyone for staying with us. So we always try to bring the most topical sort of trends that are happening both on the X timeline, but as it relates to our own experiences as well with our background. So super excited to chat about tokenized equities, which is bombarding the timeline right now.
GMU. I went into crypto thinking I could escape traditional capital markets, and here I am 2 years later talking about equities coming on chain. So it's come full circle, and I'm excited to talk about it. So let's get to it.
The circle is closing. So before we begin, everybody, let's try to break that record of 500 viewers. So let's do us a favor, share. If you're watching this on LinkedIn, if you're watching this on YouTube, or you're watching this on X, make sure you do us a favor and share this, repost it, comment. We see already a lot of comments from our lovely community over here. Even a team member already reposted this stream. Thank you, Richie. And so let's start with this topic because it's going to be a lot of discussion about it. There's a lot of things happening. So I'm going to share some news that has happened. So this is the tokenized equity. Tell us, guys, for somebody who hasn't heard what's happening or haven't read any of this news happening all around, tell us what's tokenized equity. Any of you can jump in.
Yeah, maybe I'll start with more foundational principles, and then we can go into the tokenized representation of them. So I think the first question is, what is equity? There are a lot of different financial instruments which one could invest into, more from a TradFi, from a Web2 perspective. The ones that are most often talked about for everyday investors are stocks and bonds. Equity is equivalent to a stock. What is equity? Equity is it means that you own a share of an operational company. Now, equity can come in various forms. Like you can actually, the old school way is you would receive like a certificate that says you own one, stock certificate of Apple. That's evolved over time to more digital means where your broker will hold them in some sort of digital ledger. And this is off chain. What does a stock give you? In its most simple form, there are two main benefits to holding the stock. One is an economic benefit. So you actually own a share of the profits of the company. The company can decide if they and when they want to distribute those your economic share in the form of a dividend. But also importantly, it gives you legal rights into the company. So, from a TradFi perspective, I come from a background of mergers and acquisitions, and understanding the shareholder register and therefore the ability to quote unquote control a company is one of the most important functions of a stock. So very simplistically, there are two different functions. What is tokenized equity? Very simplistic. It's a digital token that sits on a blockchain that represents a share of an equity. So that is to say, it's a wrapper. It's not a newly issued instrument. It's a wrapper of something that exists off chain that mirrors only one of those two benefits. It only mirrors the economic benefit, but does not confer over the legal rights. Now, that's a broad term, and we can dive into that. But the form that has been released or that's getting different attention at least over the last week. Broadly, that is what has been introduced.
Anything you would like to add, Cholo? Thanks for that, Patrick. That's very thorough.
I think we'll dig into the weeds a little bit, but I think crypto is always kind of like all about nuance, and I think the nuance that people are missing around tokenized equity is with equity, as Patrick mentioned. Ultimately, there is a direct line between who holds a share, and I guess in this case, who holds a script, that's what we call it in TradFi, and who has the rights. And there are various permutations around these structures that have come out into the market. Again, we'll dig into that in the next couple of questions, but fundamentally, there is a huge difference between owning a tokenized representation of an economic right on the blockchain and actually owning a thing. It's I guess it's akin to owning like a pair of Jordans and owning the right to buy those Jordans. Like so there's kind of like inviolable, immutable, I guess in the words of Web3. There are certain immutable rights that accrue to holders of the actual equity, and there are certain rights that are really to a certain extent up to the issuer of the tokenized version of the equity. Again, we'll get into the weeds of this a little bit around the different structures that have come out to the market. There's been at least 3 or 4 that have hit the screens in the last couple of weeks. So yeah, there's nuance in it. I guess it's like I would say like a Tesla in your wallet may not necessarily represent a Tesla in the stock market. So we'll go into that in the next couple of questions. But I think I would say like for the audience, just like think about that, like really understand like DYOR, understand what you're holding, what rights you hold, whether that's enough for you or you want to get the next layer of additional kind of like privileges, I guess.
And I think we've seen this on the cycles. Like I think a while back, people would think, I have some token from a project. I own part of the project, and this has changed. And now, like projects fund through equity, they do not give tokens. So there has been a shift, and I think this is kind of what we've been seeing here. So tell us the difference between the public equity and private equity, because I think that's very different. There's a distinguish that must be done here.
Yeah, no, it's an interesting question, and there's a very pronounced difference in how they're even seen as different asset classes in a TradFi perspective. So public equities broadly is any equity share that has been made available to retail, so to the broader public, and that's normally done through the form of an IPO. In the last pod, we talked about Circle, and they were thinking about an IPO, and they ultimately did follow through with their IPO. So that means that a company decides that there's a certain percentage of shares or of ownership of their company that they are open to allowing the retail investor to own share of their company. Why would they do this? There's a number of reasons. I mean, one is of course capital. The capital injection that comes into the company from retail, but there's also, it's sort of for any company in the U.S., for example, it's like the dream. You've made it when you're listed on the New York Stock Exchange and you can ring the opening bell in Wall Street. So it's an aspirational thing as well. So I would say broadly, any public stock is a company that's reached a certain scale. Both like from an economic perspective and from a business perspective, that it's reputable enough that the regulators will allow you to sell it to a very broad audience, but then also that there's demand for it, so people will buy it. Private equity is very different. Private equity, you're still buying the same instrument, you're still buying shares of the company, but it's much earlier in the funding life of a company. So usually the types of buyers for private equity are, private equity is literally an industry. It was created, in the 1980s with firms like KKR and TPG and Carlyle and firms like that, who get in very early. They get in very early to companies who, from I guess the VC equivalent or the startup equivalent is, maybe they've raised in, Series A, Series B, they've gone to a certain scale, but they're still, they're still early, like relatively early on in their life. And so, private equity is the ability for sophisticated financial institutions or individuals to get access in the form of shares to these companies, but it's not made available to the public. So these are typically, private equity professionals spend their entire life trying to source these deals. They fly across the world. They're always looking for the most promising entrepreneurs and companies that they're quote unquote early to, that they can help grow along the way. So I guess, all of that in a nutshell is to say it's the same instrument, but it's like who has access to these deals. and how early in the company's life cycle is it?
I will add a nuance here, and I think this is like a very a crypto thing like that has happened, and I agree with like with Patrick. That's how the market has evolved. But I think one of the other distinctions between public and private equity is what do you need to do to get capital? What do you need to do to get funding? And for the most part, I think private equity, the traditional VC space, existed because a lot of these companies that were very high potential had a very difficult time raising money from just raising money full stop, right? So you had the likes of Yahoo, you had the likes of Google. They were very nascent when they essentially were showing very strong signs of product market fit. But for the most part, banks would just be like, well, this is an unproven business model. This is internet based. I don't know how to value this, so I'm not going to lend you money, or I'm not going to give you capital to grow your business. And kind of like private equity, venture capital kind of stepped in and provided that growth funding to kind of like let those companies move into the next phase of growth. Now, crypto over the last kind of like 6-7 years has kind of turned that formula on its head, because starting from the recent ICO boom, from the very first ICO boom in 2017, you had the ability for these very early stage companies to essentially form capital in a way that was not beholden to these like traditional gatekeepers in like VC or traditional finance. So I guess to a certain extent, the difference between private and public equity today is really like, what do you need to do to get money? Like, you have very profitable and very not profitable, very large revenue, large scale companies like Uber, Airbnb, that managed to raise multiple rounds of very significant funding through the private markets, because they didn't have to like do the whole like, I guess, song and dance of disclosures to the SEC, making IPO filings, and that takes a lot of work. That takes a lot of money as well. But they were able to get like this kind of like pool of capital from private investors that were able to continue to fund their growth until they felt they were ready to go to the market. I mean, Circle is a great example of that. They bootstrapped through private funding through multiple years, and they were able to kind of IPO into a very conducive market for them, from a crypto regulation standpoint. So I think the lines are getting very blurred. One of the good columnists I follow, like Matt Levine, says the really big the only distinction at this stage of public and private companies is their willingness to provide disclosure, which is like their willingness to show the public their financials and what they're doing under the hood, for them to make an informed decision. And I think that line is getting blurred very quickly with crypto and with tokenized equities. That line is getting even more blurred. So it'll be very interesting to follow this space over the next couple of years.
In your opinion, for the retail user, normal person who wants to buy, I could go and open an account on, I don't know, eToro, and buy, I don't know, Tesla stock. Why would I go to Bybit and buy a tokenized Tesla stock? What's the incentive for me? Why would I do that?
We'll start with what's being marketed, because that's what I think that's why these things were innovated. So I guess, to your point, the question is always, there's new innovation. What's the pain point of a customer, and why are you doing this? Like what makes you create this like different product? The immediate there's a few dimensions here. The first one is so stock markets trade on they don't trade 24/7. So they're basically 5 days a week, Monday to Friday. And trading hours, which trading hours are, for all intents and purposes, 9 to 5 Eastern Standard Time, because that's where Wall Street and New York is. So there's a lot of hours that you can trade stocks and OTC markets and more, like opaque markets, but in general, the public markets are closed. That includes weekends. There are a lot of events and a lot of things that can happen overnight, a lot of things that can happen over the weekend. So investors sometimes feel like, oh, I need to get in and out of my positions, or I'm not happy with some news that happens, so I want to trade this instrument. But they can't, just because that's the way that the markets are set up. That's why you tend to see a lot of price movement at the open and the close of every single trading day. So the tokenized version claims to eliminate some of that with 24/7 access. I guess, I mean, we can get into it. That's not the case with the versions that have been released, because of the fact that they are mirrors of of the off-chain instruments, which basically means that maybe you can you can trade a token representation on a weekend, which is going to be very illiquid, because the underlying is not trading, but someone is taking that risk somewhere in the chain, which in crypto most of the time means that the market makers are taking that risk to create liquidity for that. So the price action is not it's an irregular price action, which is very similar to the irregular price action which happens between trading hours in TradFi. So that's just one, and we can dive into that because that's actually a very important nuance here. The second is fractionalization. So I mean, with equities, this isn't really an issue, but for public equities, but maybe if you're trying to get into private shares or private equities, they probably have higher minimum investment sizes. So tokenization allows you to fractionalize that into smaller bite sizes, which could be accessible to retail. Accessibility it's a real issue. So the products right now that most of the market entrants have announced are the trading of US, so like large US equities, large US ETFs, and the thesis is that they're opening up that inventory to European, to Asian buyers that maybe didn't have access to this before. I think there is a set of people where that is probably the case. I'm a U.S. passport holder that lives in Singapore. Would I buy the tokenized equity version over something I can get on Interactive Brokers? No. Which again, we can dive into that. And then the last thing I'll say is access. So access more just from a less the public equity side, but more the private equity side. So to the degree that you now have access to an OpenAI, or some name your private company that SpaceX or something like that, which you want exposure to, but you previously couldn't. There's starting to be tokenized representations of private equity. So I think that those were, in a nutshell, a lot of the problems that were trying to be solved with tokenized equity. This is a first stab at it. So I think that first of all, I think it's great that the space is trying to innovate products. But I think also it's probably a first iteration that needs to go through a number of different, I think improvements before it really achieves mass adoption.
I guess what I'll say is like I always ask a question like who wants this? I guess. Well, I mean, people want it clearly. Like there's a bunch of TVL on demand on it, but I guess from a perspective like whose problem does this solve? Like from to Patrick's point, like most people from developed markets, most people who are AIs in their respective markets can get access to most of these public equities through setting up a private, Interactive Brokers account, like a Wanda private markets account. There's multiple discount brokers that will give you access to these products if you wanted it. And like, if you wanted to get leverage from that to go ape into crypto, that's possible in Interactive Brokers now. Like Bitcoin and ETH and Solana and XRP are on those platforms. So like we're just like the whole like kind of like dream of like leveraging everything and then buying everything. That's kind of possible now in some of the discount brokers. So I don't think it's solving a problem for the consumer that is like high value from a brokerage standpoint, right? Then you look into the perspective like, is it really solving a problem for the private market participants? Like, I don't think SpaceX is gonna run a tokenized equity fundraise through Robinhood tomorrow, right? I think the volume they're gonna get is gonna be a pittance versus where they get from traditional routes. I think even OpenAI, as I said, like we do not endorse this thing that Robinhood has done. So it's solving really a problem for maybe like private shareholders of SpaceX and OpenAI. There's multiple routes you can go over that. You can sell it to like SPVs. You can sell it to like angel syndicates that want exposure to that. So, I mean, I guess when the news first hit the wire, I was like, yeah, okay, this is cool. It's a cool narrative. It's a cool story. What problem are you solving? Because there are very defined ways for people to get liquidity either ways, right? Whether as a buyer or as a seller for most of these, or actually for all of these public and private equities. And if you're a private equity that doesn't have a buyer in the secondary market, in the OTC market, you're probably not a company no one wants to invest in anyway. So bringing it out on chain doesn't really create liquidity for you. So it does address an access problem for a long tail of users. I just wonder if that's a long tail of users that these platforms or these private equity issuers really want.
Yeah, and I just want to add one point to what Cholo was mentioning. This is not the first time that we've seen this type of product in crypto. I mean, we saw this in DeFi summer in 2020. I mean, there were companies out there like Synthetics that were issuing synthetic stocks, and they were literally synthetic Tesla stocks, like the highly demanded things that retail probably wanted. Similar model, they gave you price exposure, but didn't really give you legal ownership of the asset. I guess, DeFi summer sort of had its own issues. What I was going to say is, that, did it have long-term demand? We all know how DeFi summer went, but it's kind of, at least this iteration looks and feels and smells to me like a similar instrument. Now, I know that it's not the end game. I know that everyone is talking about how do we move this forward to primary equity issuances on chain, but the current iteration of the product is definitely a first. It's a first foray given the current legal environment and the current atmosphere of what various jurisdictions are allowing builders to create.
And tell me, I just want to go back to your first point, the difference of time trading. Do you think there's going to be any arbitrage opportunities, or the trading is going to be so minimal that there would not be any price impact?
I can take it first. I can take it first up. I think it is the age-old question of how do you solve the Oracle problem, and it's tough, right? Like, because essentially what crypto does really well, even with like protocols like Aave or like collateralized lending on chain, is that the liquidation markets for the asset that you're holding lives on the same settlement time frame and rails as the asset you want to sell. So if you want to liquidate someone over the weekend, sure, that's fine. Like, you can liquidate Bitcoin over the weekend. Liquidity is super like liquid. You can like clear a couple of tens of BTC through like the bid ask of like large exchanges, no problem. If you do that, then like with tokenized equities, when markets are shut over the weekend, good luck. Like your bid ask spread is gonna be like 20%. Like, if you wanted to liquidate something that is on paper worth $300, if some war happens, if like some country drops a bomb on another country, that $50 bid ask spread becomes like a $200 bid ask spread. So good luck getting out without any kind of loss on your portfolio. And I think that's what's going to give a lot of market makers and a lot of like money markets a lot of pause around adopting these assets as collateral with very tight kind of like liquidation preferences. They will actually make it very wide. They'll make it, to a certain extent, uneconomical for people to use them as liquidity or as collateral, which kind of defeats the purpose. Like, the fact that we want to bring these things on chain is that people can do different things to them. People can do DeFi with them. But if you're kind of hamstringing them because of like not your own constraints, but like timing constraints from their home exchange, then you're kind of like really shooting yourself in the foot. So it'll be interesting to see what happens. I know Camino has launched support for X stocks. I haven't really clicked into it and see like what the bid ask spread is, but the real test happens when some geopolitical thing happens over the weekend. And we've seen this in DeFi multiple times. DeFi has actually performed pretty okay. Like, liquidations happen orderly. There's no bad debt that happens in the system because Bitcoin, Ether, Sol travel on the same rails as where they're borrowed. In this instance, you're borrowing something that's faster than what you're collateralizing, and you're essentially transferring the risk to the platform around how do you liquidate this in an orderly manner to preserve your risk. And it creates just like a whole host of risk management issues for platforms that take this as collateral.
Yeah, and even like I want to double click into that, because one of the things that I always think of in DeFi is, what is the composability use case of this thing? We talk about it a lot, with our product, and why we think that we're a sustainable Lego. When you think of having a base layer to be composable into other DeFi, what do you need? You need something that won't move on you a lot, so you won't get liquidated out of your position. I mean, so the most easy parallel is, most people have probably tried perps, and trade Bitcoin or trade Ethereum or Solana or whatever on leverage, right? And what do people like to say? Oh, I like to trade on 100x. What does it mean when you're trading on 100x? It means a 1% movement in your underlying probably means that you got liquidated, right? This dynamic that's being created and this is like where I was kind of like thinking about this is, the problem is like outside of normal trading hours, because of the fact that everything we were just saying, that market makers have to price in like broad spreads. So first of all, you're not even getting the right pricing on the underlying asset. And second, when something does happen on the weekend, these spreads blow out. Like they blow out wildly, which also means that your underlying collateral is probably getting blown out. Like, so it just like I would never want to be held like caught holding a position on any weekend, with this as collateral, because you're always taking the risk that there's some, and it may just be a blip. It may be that the president of the U.S. announced something on True Social, and then it just moved markets by 5%. It's going to blow your position out if you have any like moderate position of leverage put on. So for me, I think about it in again in the lens of, do I want this as like a composable DeFi Lego? I just think that it introduces so much price risk that if I really wanted to, the reason I'd want to use it in money market is because I want to loop it and I want to borrow against it and put leverage against it. But how can I trust an asset where I know that there's going to be this volatility, anytime that the trading hours aren't happening? So, it's a theoretical question, but that's actually like one of the first things I thought about when I thought about DeFi composability for this particular asset.
And why do you think is happening now? Why we see suddenly all these announcements, and why we see an alliance? Like this is not one project deciding. This is an alliance, and big players are joining. So why do you think this is happening?
Yeah, I mean, I'll take a stab at this one first. And as you know, we're based out here in Asia, and we sort of we work within the regulatory constraints out here. Most of the innovation is being announced by largely U.S. players, and the fact that it's we just came back from New York 3 weeks ago, and so we were on the ground, and we heard a lot of noise. And I think the fact of the matter is, especially when you have so many large players announcing something at the same time, it probably means that there's implicit approval by the regulators in that market that they'll allow some sort of product. Now, what's interesting is, and I would expand that to say it's not just Web3 players. I mean, you mentioned at the top of the pod that like large Web2 players like Robinhood have entered the chat. Their product is they haven't announced all the composability stuff that I was just talking about, like on their product, but the Web3 guys certainly think that way. But what's interesting is it's geofenced in their backyard. So these products are not offered in the U.S. There's an SPV that sits in the U.S. that's regulated out in Liechtenstein, in another jurisdiction, for distribution in Europe and Asia, right? So it's clear that there was some movement in terms of the regulatory guardrails, which again, I think all of this is super positive, that it's headed in the right direction. But I think that there's also a lot that is evolving and probably will continue to evolve, that gives larger players and builders at large more comfort of the type of things that can be introduced into the market.
I always say back in the trading desk, look at the tape. Don't take whatever people say as a face value. Look at the tape means what are the actual trades that are happening on the ground. And if we just look at DeFi Llama as a barometer, right? Xstocks and BackFi combined, their TVL is a shade under 50 million. Equities globally, US equities, just from a pure market cap standpoint, is 50 trillion. So I think sometimes we get caught in this trap with CT and crypto, 50 million is such a huge amount, but the market is 50 trillion. We are 0.1% of getting there. So people saying this is going to be the next wave of what brings crypto adoption into adoption into crypto. I would say that's still a very premature conclusion to make. This is basically just a product that crypto natives are adopting because they probably don't have access. Are we bringing the normies in, or are we bringing the mom and pop, or bringing the 401k guys in the US into crypto? That is the large majority of that 50 trillion market I mentioned. No, we're not. We have to have a very compelling use case for bringing them on chain. And until we get that, we're not going to bring them over. So I think people are very bigged up on this narrative. I think there are very many takes on Twitter. There are very balanced takes, also very kind of hopium takes. I would take all that with a grain of salt, and we just look at the tape. Look at how much of these protocols are actually attracting meaningful TVL, how much of that TVL is bleeding out into DeFi, how much of that is actually going into on-chain. Because outside of that, then I would say that this has the potential to becoming just like another Tether corridor for Tron, which most people think are like, there's a big Tether USDT corridor on Tron. None of that goes on chain. So are we creating that kind of like corridor, which is kind of like a cool narrative to say, but it doesn't really bleed out into value into DeFi? Or is it something that is the beginnings of a real healthy ecosystem around tokenized equities? I think the jury's out on that one, but it's going to take a couple of months or a couple of quarters at least to see how that plays out.
And who do you think would be the most benefit, the retail or the institutions, once this goes into the future, if this starts becoming the thing that is gonna keep happening?
I think a bit of both. Institutions and retail always have a very symbiotic relationship when they both coexist in a space together. Like even in traditional markets, even in equity markets, retail forms a large part of trading for most of these like meme stocks, or even like bellwethers like the Magic 7, right? The Fan Mag and all that. But you do need those institutions to provide liquidity, and the institutions provide liquidity when not. I mean, like again, CD thinks about this the wrong way, that they think that institutions only come in to dunk on retail. That's not the case. Institutions come in to make money off delta neutral strategies, providing healthy bid-ask spreads on both sides of the coin. If your stock is down only, institutions don't care, because like basically they're just gonna keep buying your shit token or shit stock all the way to the bottom. But if there's healthy two-way liquidity, which means there's healthy retail participation, institutions will play ball, because they think that I can make money providing liquidity to the market, not dunking on retail, not extracting value, but providing a means for a market to form over this nascent asset. And it's the same in the equities or tokens, wherever. And with tokenized stocks, they need to see the value of bringing that market making expertise on chain. And right now, I think the volumes are too low for them to see that's a very worthy investment. So I guess we need to kind of, as an industry, kind of create that utility for them. As Pat mentioned, it's very early innings around how this thing will evolve. But if we can create that kind of like business case for institutions to come on board, they will come with their dollars and it will provide liquidity. It's just a matter of like creating it in a way that is like net positive for them.
Yeah, and I think I was thinking about this in multiple lenses. But the one I think that's the most important is what Cholo mentioned before. I mean, for any retail user, for any investor in crypto, DYOR, I mean, that's the most important thing for any product that's being introduced on chain. And I feel like because of all this discussion that we said, the sophisticated insti understands the game. They understand the limitations of the product. They understand how the trading and the money flows will work around the disconnect on off-chain and on-chain in this product. So sophisticated investors always play both sides of the trade, and there's nothing wrong with that. You can make money when markets go up, and you can make money when markets go down. I would say in general, retail doesn't do that. Retail tends to, buy and hold and, up and to the right always, or that's like the perspective that people want to have. So unfortunately, that creates this dynamic where, at least right now, the game is already rigged. The game is already rigged, and it's not rigged in retail's favor. So I think that it is because of the construction. It's because of the way that the money will actually move. That's the current. Like I feel that that's the current dynamic. Like let's see how this plays out. But we talk to market participants all the time, and I feel like this is the way that it would probably play out. But I do think that over time, also. Clearly, if there's no demand for a product, then the product needs to probably change, and there'll be different forms, and hopefully the regulation continues in a form that allows the innovation to happen. But yeah, to your point, I just feel like the winners right now are instis, not retail.
Fair enough. And touching the point that you said that the game's already rigged, something that you've already mentioned a few times, and I think this is a huge topic of discussion, is voting rights and what owning an equity gives you that is not seen here. Tell me about that. Like, do people just care about the price? What's going to happen with this voting? This voting going to go to the platform, the dividends. Where are those going to go? Some investors live off dividends. Like, how is that going to affect? What's
Yeah,
happening with all this?
no, absolutely. So dividends and voting rights, two different issues. But let me start with the voting. This is something that's very near and dear to my heart. So in the TradFi world, you have legal rights over a company. Sometimes in some jurisdictions, even with a 1% ownership of a company. Let's just take the U.S. Let's take the U.S. since it's where a lot of this innovation is happening. In the U.S., I mean, if you're a Berkshire Hathaway shareholder, you buy one share just so you can show up at the annual shareholder meeting, right? I mean, that's like that's a benefit. Like participating in the company, listening to the management, like having a say. Anytime there is any corporate action that requires a shareholder vote, there is a shareholder vote that's put in the mail and mailed to you, or sometimes now it's electronically. But you have, like, most people, I wouldn't say most, a lot of people abstain or they just miss them and they don't vote, and that's fine. But you have the opportunity to. So and then going further down the track, which I don't think retail think about this, but maybe down the line more like institutional type crypto people might think about this. But shareholder activism is a whole business in the US, and that's the market that we're talking about. And a 5% shareholding gives you significant rights to agitate in a company. Where we're based now in APAC, it's harder to do agitation like that. You probably need significant blocks, like 33%, 49, 51% to really make noise. But it's not the same in the US, which is the markets that we're talking about. So there are significant rights attached to owning the equity or the share of a company, and that's just on the sort of on the legal right perspective. What happens in this form is anyone that buys the tokenized representation. Now there will be a servicer or a provider that holds all of those shares in an SPV. So effectively, let's just say Robinhood is the one that's creating the SPV. Robinhood essentially takes all the rights, all the legal rights of all the shareholders that are buying tokenized representation of these stocks. Is that good or bad? Well, actually, if I'm a company, then you're actually introducing this risk. It's like, wait, Robinhood is now like a 7% shareholder, which used to be like 2,000 mom and pops, and now it's coalesced into 7% of Robinhood. If I'm a company, that's a real consideration. Like, I don't like that. But for thinking more from the investor perspective, from a retail perspective, you're just giving up these rights. To your point, yeah, dividends are significant. I mean, on companies that are really profitable companies. I mean, some people invest in companies just because they want that, whatever they think they're going to get, a 4% dividend, 5% dividend and annually, and you don't get that in the tokenized representation. Now, I think the calculus that's being done in the back is, there's this sense that crypto users are looking for more of the trading on it, so they just want the quick buck, and they're not thinking about like the 5% dividend that's going to happen at year end or quarterly or whenever the dividends are announced. I mean, I reject that theory. I mean, it's money that's being left on the table. So why would you? Why would you? Why would you give up those rights when you have a equivalent like delivery form off chain with more significant rights? So for me, I think those are two very important considerations.
2 points I'll make. One is a more cheeky point, is the prime candidate for tokenization is Berkshire Hathaway Class A shares. There's like 700,000 per one share. It's like a house in most places, like multiple houses in emerging markets. So if any share needs to be tokenized and get more access, Berkshire A is probably the main candidate. But jokes aside, the second point is like, I definitely agree with everything Patrick said. What I would say is just like an additive is that crypto has actually created these coordination mechanisms. We've actually perfected, to a certain extent, these coordination mechanisms in DeFi. Like we have Convex or the Convex forks, where essentially it's using voting shares and Curve to drive outcomes through bribes, through essentially driving voting towards where it's net good for the VE Curve, the Curve stakers, right? And I think that's actually a very powerful mechanic that the more forward-thinking founders or the more forward-thinking like management teams in TradFi will see as a very useful element, right? Because like to Patrick's point, like when shareholder votes happen in TradFi, it's normally working through many layers of intermediaries, and it'll say like, hey, trust me, bro, I'm going to get you like 60% of this vote because I'm going to give them this kind of bribe or that kind of bribe. But in crypto, we've actually created this mechanism through gauged voting that you can actually define the bribes you want and see the outcome you see in real time when you push through like a snapshot vote or you push through a governance vote. And I think that's something that crypto has kind of like made that governance aspect of TradFi more efficient, but it hasn't really gotten that much headline news. But over time, if we see more of these SPVs getting spun up, owning kind of these chunks of shares in public or private companies, we can see sort of this like shareholder bribing to a certain extent. If that kind of evolves, I think that's something that's very exciting. It's not going to happen in the next 12 months. It probably happens over like next 36, 48 months. But the infrastructure is there around bribes and kind of like driving outcomes through economic incentives, because ultimately, as Patrick mentioned, everything in shareholder voting is economic incentives. It's like free buffet dinners, free buffet lunches, show up to the AGM and you get like some free food. It's the same thing. But here is more kind of like egalitarian. It's more kind of like inclusive. I think that's quite interesting. So this is the one aspect I think where DeFi has kind of figured it out, but it will take some time for that to filter through into tokenized equities or equities on chain.
And what legal implications you think are going to come here? Obviously, there's going to be so many aspects around it. Like, what can you see being the most obvious or the most relevant at this point before this evolve into the next stage?
Ironically, we talk about regulations in a lot of ways, always on this pod, but for this particular product, you have to remember that the thing that they're tokenizing right now, so the announcements are US, so SEC regulated securities in distribution in other markets. The person that I don't want to be holding the bag is the DeFi protocol at this point. Why? Because you don't want to be the DeFi protocol that gets caught distributing a US regulated product into a market that's not sanctioned for whatever reason, because it was packaged in a certain way, or you end up holding the underlying, and the legal risk for this particular instrument, for an SEC listed, which is the highest standard of regulatory standard equity, through DeFi channels. I mean, let the lawyer on each particular protocol figure out their comfort level, but I would be highly uncomfortable with the risk that I'm taking on there. So, which is ironic. And the reason it's ironic is because the reason that the thing was built was to create distribution in other markets that are outside the US and, provide this access. But to some degree, what they're actually doing is pushing the regulatory risk to someone else. And, if you're trying to play up the composability use case, the guy that is being composable with you is the guy that's taking the risk, which I think is a very weird dynamic.
I think ICOs show the future. What could the future could be like? It could be anyone with a white paper and a dream could essentially sell equity and build their dream. Obviously, they got co-opted by all the meme coins, all the nonsense that crypto has. But I would say ICOs in 2017 were a return to form of IPOs back in like the 1900s, where people funded ships to go out into the ocean with a dream and see what comes back. I think that is, I think directionally that's where we're gonna head back into. I think directionally regulations are catching up towards consumer behavior. When consumer behavior says like, I want to buy whatever the fuck I want, the F I want, and I don't think regulations should stop me. And regulations are like, oh, hey, sorry, we're going to stop you from investing in Ponzi's. It's kind of like that disconnect, the disparity, and I would say that we're kind of early innings in that kind of compressing. And tokenized equities are like a step change into that future where the lines between tokens like meme coins, meme stocks, meme tokens, and kind of like serious equities, serious tokens is kind of getting blurred. It's going to take multiple years for that to kind of like really kind of like evolve into what is the end state. But I personally am excited around this whole space of blurring the lines between like what is a public equity and what's a private equity, what's a tokenized share and what's a token, what's a meme coin or a meme stock. Everything will, I think, converge, because at the end of the day, governments cannot stop consumer behavior. They can only regulate it, and they will regulate it until they can't stop it. So I think tokenized equities are the next evolution of the regulation is going to be probably more access, more free flowing of these equities through multiple jurisdictions, multiple user bases, and then it will bleed out into DeFi, like unregulated or light regulated DeFi, where people can do what they want with the assets that they own. And that to me really goes back to the ethos of crypto, like your assets, your choices.
Yeah, and I just want to like double down on that point, because despite what we're saying here, I mean, you're asking very specific questions about the product design today and where it's at. So by no means are we saying that tokenized equities is good in the sense that people are moving this space forward, and people are trying to move the space forward, and they're testing and trying things, and that has to happen in concert with the regulators as well. And it is taking steps forward. So all that's positive. I think both of us, I mean, that's the reason we're building this company. That's the reason that we got into the specific niche that we did, is because we do want to push. We want to push the future of finance, and we want to find where innovation needs to happen. But it needs to happen in a space where there's real demand first, coming from the ground up, whether it's retail, whether it's institutions, there's demand for the product, and then you deliver it in a way that has not been delivered before. So all that to say, we are, of course, like we're responding to the things that we're reading on the tape and what we're hearing, in the market. So but we also think it's early days. It's early days for this product. Think it'll iterate, but kudos to the teams that are building this stuff, because this is what we love to see. RWA as a space needs multiple people trying multiple angles. So we super applaud all the innovation.
Absolutely. I think always trying and testing is good. It's great to see people trying to do these things. But on your personal opinion, like hats off, do you think this could be the next big thing? Is this what RWAs are heading? What's your take on this?
Yeah, maybe. Okay. So I'll start, and I'll say it in an ironic way. In our first public pitch at Monad Madness in Bangkok, I literally had up a slide that said, here are the things that should be tokenized. So we don't believe that everything should be tokenized. And then I had a slide that said, what are the things that probably make sense to be tokenized and don't make sense to be tokenized? And on the ladder of what doesn't make sense to be tokenized, I had equities in that bucket. The reason that I say that is you have to solve the question of, is the thing broken? Does the thing need to be improved? And how will it improve the product for the end user? For all of the reasons that we just said, I don't think that this current iteration is the final boss. There's probably other innovations, but also just more simplistically, as we look at different asset classes that should be tokenized, they should be assets that are opaque, that are broken, that there are huge gaps in either understanding or access, and there are gaps because they were created by the traditional system. We've chosen an asset class that we think fits all of that criteria. I do not think that tokenized equities fits all of that criteria.
I have a slightly different take. I'm to be fair, like I conceptualized that slide, and like we made that slide together. I still believe that slide. That slide is probably true for the next 3 to 5 years. Where I'm going with my answer is that when we think about like the future, and the future is kind of like, it could be like tomorrow, or it could be like 10 years from now. I think the future is everything on chain. Like I fundamentally believe that. The velocity by which that happens is a subjective thing. I don't think it happens in the next 3 to 5 years. I agree with Patrick. The first things we should tokenize are the things that more fit the behavior on chain. But the fundamental other kind of aspect of it is that change doesn't happen overnight. Change happens through generational shifts. And the reality is large majority of allocators today are still people who are much older than us. They call them boomers. Like I don't like that term so much, but they still behave in a way that they prefer their investments sit in a very specific distribution rail, and we're never going to change that. I mean, like whether crypto wants to believe it or not, we're not going to change that. We're not going to change behavior. But what we do have in our favor is that the next generation, the Gen Zs, Gen Alphas, they're an internet native. They're coming into this world where crypto is just a fundamental piece of the financial infrastructure. And they're going to demand that these things that they want, that are fixed income products, equities, all that kind of stuff, lives on the same chain that they are comfortable with. And I think that's what's going to usher in that change. So that's why I think that the future is tokenized equities, but it's not going to be next 5 years. It's going to be next 7 to 10 years when these audiences become kind of like affluent enough in their own right where they can essentially dictate terms for the financial systems that address their needs, their pain points. Because we're not gonna onboard the next billion users by turning boomers into on-chain users. I think that's just like a pipe dream at this stage. One, it is building infrastructure so that when this next generation of audience comes on stream, we're ready for it. And I think that's what we think about when we kind of build. It's not about addressing the old majority. It's addressing the next majority, I guess, in a certain sense.
And tell me something. This is just for my personal knowledge. Who's gonna regulate all this? Like, there should be one per one. So I tokenize an equity, but we've heard that in stable coins, and there should be $1 for one USD. But sometimes there's rumors that doesn't happen. Like, what can happen if suddenly there's no 1-1 and they start making this tokenized equity out of nowhere? Like, who's gonna police this, and what could happen if this starts happening?
I think I think the scenario that you mentioned is probably going to start happening because that's kind of the way that innovation goes, right? Like people try all different types of forms of innovation. Some people work within regulatory guardrails. Some people, try to push the limits. So I think that to your first question of like who regulates the stuff, I mean, this is a very nuanced question because it matters both where you originate the thing. So for most of the assets that are coming on chain, they're U.S. equities, so they're regulated by the U.S. SEC. But it also matters where you distribute the thing, and so both ends of the chain matter. As we've talked about a lot, the regulatory regimes globally are not aligned. I mean, they're influenced by each other. They watch what's happening in other regions, but yeah, I mean, it's possible that even tokenized equities can take a different form in different markets depending on what regulators are comfortable with or what political or geopolitical objectives they have.
I would say it's like code is law. If you put it on chain, if it's natively on chain, the only regulator is the blockchain. You can't double count things that are on blockchain natively. So that's why people always say Holy Grail is like native on-chain equity issuance, native bond issuance on chain. Because if it's on chain, it is immutable, it is unduplicatable, and that's your best guardrail against fraud.
Unbelievable. We're gonna go to our final part, and this is rapid questions. And this, if it's your first time watching, I just ask a question given by the community, and our founders just answer really quick. So we're gonna start with a hard one.
That's
overall feedback of the egg hunt.
Egg hunt. I think it was great. I think that we got to know our community. They got to know us. It was a lot of fun, a lot of work. Internally, what people don't see under the hood is it actually but it made us learn a lot about our own internal processes, like how we address crises, how we address customer complaints, but also how we address kind of just velocity of building stuff. So it was, I think, maybe it was more beneficial for us or productive for us internally than was to the community. But I hope the community had a lot of fun because we had a lot of fun doing it.
Yeah, I would say, I mean, honestly, I would use the word phenomenal. And then the reason I said that was because for the community, you have to remember where we came from. When we started this, like our X was like 100. We had like 100, less than 100 subscribers on X. And this was really our first major campaign to try to get out there in the public and be public and do something fun that, you know, that the users, the community would like, but hopefully, you know, build a bunch of users that will continue to follow the Mu Digital story. In normal entrepreneur parlance, like your first 100 customers are like the hardest to get. I use our NFT mint, which is happening tomorrow, you know, as the proxy, and you know, we've more than tripled that. So I think it's a phenomenal outcome. You know, I think that the community was super engaged. Personally, as the riddle writer, if you guys didn't know, I was the riddle writer. I was a game master. So no, I mean, I thought it was awesome the way that people engaged. So I had a lot of fun, and you know, who knows? I thought it was super successful. Maybe there's a round two, you know, sometime down the road, but let's see.
Okay, next question. Favorite country to create yields on APAC?
Sorry, I didn't get the first part. Sorry.
What's your favorite country to create yields in APAC?
I let Patrick go first.
No, this is like a super hard question to answer. And the reason why I say this is because every market will have different types of things which we think are awesome, like different types of deals which are very unique. And we actually, I mean, as the community knows, we spend time traveling across the markets and finding deals and originating stuff. That's what we did in our past careers. And that's why I don't want to like pin it one, because if I say one, then I'm going to alienate other markets. Things that I think are super interesting and topical, just like specific things. Vietnam was always a super interesting market, like when I was in TradFi, and it continues to be. The types of investments you can find, because it's a very frontier emerging market, which a lot of interesting investments happening there. I personally love Korea as a market because I think there's a lot of super interesting industries. Hi, K-pop demon hunters. Thailand is an awesome market. We always see that, you know, the market AI, like AI GPU centers is like a huge topic there. We're both Filipino, so of course we always love, you know, trying to support like local Philippine businesses. So I used a bunch of different things because I honestly I enjoy trying to find stuff across multiple markets.
Mine is easy. I'm Filipino, so I will say Philippines. So there's no choice. That's why my Patrick goes first. He's American, so he doesn't have a home country here in Asia, unlike me.
For those of you who were paying attention, Patrick dropped a little hidden bomb in there, so we might do something with that later on to our community. So moving to our next question, how many MUBON do you own in your wallet?
I don't know, man. I think like 1,000 or something. I'll be honest. Like in the treasury wallet, there's a lot more, obviously, which I manage.
Yeah,
my own wallet is 1,000.
Yeah, no, it's interesting because we do a lot of like testing with our products. So like we trade in and out. So to be honest, I don't even know. And we also control the treasury. So we put a lot of MUBONs into our personal wallet. So if the question is like, how many times have I interacted with the MUBON? Like every single integration that we've done, I've interacted, you know, MUBON. So if you go on our testnet, like we've, I think at this point, 8 different integrations, and I've used every single one. So I traded a lot because I need to make sure that, but yeah, I think my numbers are skewed because one, it's not real money, it's testnet money, and two, because we have access to the treasury.
Fair enough. I think if I ask RWA WAGMI, that would be a different answer. I know Cholo owns a big chunk of it.
I have a lot, so don't ask me how much I own.
Okay, so we've come to the end of our program. Thank you very much, Patrick. Thank you very much, Cholo. It's been great to chat with you. It's been a fantastic topic. I think there's going to be much more to come about this. We're going to see a lot of things developing, not only in the next couple of weeks or months, but as Cholo said, this is going to take years to unravel. Would you like to say anything before we close, Patrick and Cholo, or goodbye?
Yeah, just a quick one. I think, you know, for our community, again, thank you for following us for 4 episodes on this. We've got some super interesting programming coming up that we've been lining up. I won't drop specifically who it is, but you can expect some super talented founders within the community that we are in to come on the show soon, and we're super happy to host them. So look out for that within the coming weeks.
The only thing I add is first of all, thank you. Thank you for being with us. Thank you for being able to sit on this journey. But also we welcome all feedback. Our Discord is open. Come on board, talk to us, raise a ticket. Tell us what you want to hear from us moving forward. If this stuff is useful, maybe more deep dives into that, like what we talk about here is useful. We're all ears. So we always want to understand what our community wants to hear and try to orient our approach to that. So thank you very much for being on this journey with us, and looking forward to continuing on this journey with you guys.
Thank you everybody for watching. This has been amazing, and we'll see you on episode 5. Thank you very much, everyone. Bye bye.
Mew.
Jimmy.
Gmu.